Okay, we've heard the recording message, so I want to welcome everyone to the third in our series of 4 webinars. Today's session, my name is Chris Cooper. I'm with the Ohio Employee Ownership Center at Kent State University. And today's session is I think, an important session. It's a way for you to look at strategies to transfer your business while meeting both your planning goals and your tax goals. So today's speakers, we have Dave Umbaugh from Hudson in Ohio here. He's an attorney at law. And we also have Andy Maimona, who's a certified financial planner out in Stowe here in Northeast Ohio. So I want to welcome them. They've spoken many times at our face-to-face meetings that we've had in Northeast Ohio, and we're pleased to have them here today. And want to let everyone know that if you want to ask a question, you can always hit the raise your hand button on the lower left-hand corner of your screen. You can always send me a chat message. We'll get the question out to the presenters. And we will be opening up the phone lines at a couple points throughout the presentations today for voice questions. So I think I am going to summarily shut my mouth and turn it over to our speakers.
All right, Chris. Well, thank you for allowing us, Andy and I, to speak with your participants today. Speaking is David Umbaugh, and with me to my left is Andy Maimona. Andy and I and Andy's partner, David Heffelman, several years ago formed a company called Ohio Exit Planning, shown on your screen there, for the specific reason of consulting with small business owners and giving them guidance on how to plan for the eventual exit from their business, transition of their business from the owner or owners to new owners. And the reason we've done this is it's been Andy's experience and mine and David's that the consulting that's necessary there is an odd blend of financial planning, legal planning, and also there are certainly some tax and accounting issues here that call loudly for a capable CPA. Our hope today is to use the webinar, and I will say that this is my first experience with the webinar, and it'll be fun to see if we can make this technology very meaningful to the listeners. In my imagination, our specific listener is a small business owner who is seeking information on how to strategically organize his affairs so that he or she, of course, can successfully transfer his business probably in a period of time ranging from 2 to 5 or 6 years from now. There's no magic to that date, but this is not a discussion on how to transfer it tomorrow. This is a discussion on how to guide a business owner and how to do that transition in a few years. It is also limited, although we certainly more broadly speak. Today, our discussion is limited to the transfer of the business in a probable way, not to a third party who buys it for cash, but rather the transfer is expected, not certainly perhaps, but expected to be to an individual who is what we loosely call an insider. One or more insiders who typically are one of the following. Often a key employee or key employees, plural. Sometimes a family member. That's an insider transaction as opposed to somebody that comes down the pike 5 years from now and offers a cash deal to our business owner. So we're going to limit our discussion to that scenario and how we can best organize the business affairs and the owner's affairs to enhance that possibility. We might say, as a prelude, that more than half of businesses, when they transfer, small businesses, that is closely held businesses, do not sell to a third party, but rather sell or transfer to what we are calling an insider, a key employee, a family member, a co-owner perhaps. And that's, again, what we will devote our talk today. There's a lot of material here, a lot of substance that we hope to describe to you in a limited time to do it. But that notwithstanding, push that raise your hand button on the screen or email Chris at Kent State University your question in textual form, and we'll do our best to answer that, and we'll also open up the forum to questions here in a few minutes. So that is a prelude. Let me as the attorney part of this group, discuss particular aspects that I have found in the 30 or odd years of so of practice that I've had here in Northeast Ohio to be particularly important to that targeted audience of the small business owner who will transfer his business in some fashion to an inside person in the next few years. Point one, and before we move on to the slides, point one, it is really important in our judgment that this plan to accomplish the successful transfer be something that is done in writing. And I want to beat that up for just a second. It is my experience that an accountant will give some advice, a financial planner will give advice, a lawyer will give advice, a business consultant will give advice, but it is extraordinarily difficult to organize those random pieces of advice into a strategic plan. And I am utterly convinced that the successful transfer calls out for a written exit plan that is put together now, rather than just ideas that continually float in our heads. If there's one thing that's perfectly clear, it is that a small business owner is overwhelmed typically by the challenges, the day-to-day challenges of running the business. And unless there is a written plan with specific dates called out in the plan for various occurrences, various developments, I don't think that the planning is likely to be successful. One other preliminary thought. We believe it is critical that a group of professionals be specifically involved in the implementation of that plan, and that they are all on board with that plan, that their functions are specifically set out, the dates those functions will be achieved over the next, say, 3 or 4 years are highlighted, and that there are regular meetings of this advisory group so that all is coordinated, because a successful transfer of a business is unique in the sense that it truly requires, in our judgment, the participants of various professions. And specifically, that includes, in no particular order, a financial planner such as Andy, an attorney such as myself, a CPA or other tax consultant that carefully advises the business owner as to the tax strategies and implementations, as well as typically, and we're going to talk more about this, a business valuation expert, sometimes a banker, but there are 4 or 5 professions that typically get involved at various points in the process of implementation of the written exit plan. So with that said, let's try to get a little more specific with the methodology of how we accomplish that. And we're just having our first technical difficulty on our Chris, if you can do anything on your end, we can't advance there. The slides are now advancing. That's good.
David, just let me know when you want me to advance the slide.
All right, we'll do it that way. Thank you, Chris. The slide you're looking at now is the very basic key points of such a plan. I might add that there's one that I think is first that is not showing and needs to show, and that is, in my judgment, the typical written exit plan calls out first for a determination of goals. Now, that may seem self-evident, but in my opinion, it's not. A determination of goals answers questions like this. When do I, as a business owner, see myself exiting? Is that a year from now? Is that 8 years from now? And there needs to be a date put on that. Obviously, the written exit plan is not a legal document. It's a guiding bylaw of how we're going to get there. Secondly, in the goal-setting objective, we need to know who is likely to be the generic transferee. Is it going to be an insider, an employee, a group of employees, an employee we have yet to hire, a family member, a co-owner, an existing co-owner? The generic transferee needs to be isolated, not necessarily by name, but by type. And to set the goals also, we need to know where the owner needs to be, expects to be, personally, from a net worth point of view and from an income point of view. And very commonly, the written exit plan calls out for, by a date certain, that a financial plan on a personal level is accomplished for the owner, so that we have the financial objectives clearly in front of us and can take a look at that target and know where we're headed. So missing on that slide, I think, is the goal setting, which ought to be first and foremost in any written exit plan. Then we think that typically, not always, but almost always, the next step in the plan, again, a written date certain plan with specifically involved experts, will call out for a determination of the value of the business right now. And there is subtlety in that. It has been our experience that, it's been my experience, that business owners are the worst judge of the value of their business. It is my experience that very, very few business owners have a real sense of the value of their business. And we can't do good planning if we don't know what that value is. There is depth of knowledge in determining true value, fair market value, enterprise value of a company. And the written exit plans that we're a part of, that we help create, very commonly call out for, in an early stage, an appraisal of the business by a qualified business appraiser. Now, time limits us here in determining and talking about those qualifications of that appraiser, but let me say this: I think it is very important that our audience appreciate that typically the appraiser is not the lawyer, certainly, is probably not the company CPA, but is a qualified business appraiser who only does that, or that is a substantial part of his career setting, that he has testified in court with challenges to valuation, either with the IRS, perhaps a death or other scenarios, or otherwise has testified in court as to the value of the business. There is a great body of knowledge that needs to be brought to the table to determine value. So, second step, first on our slide, is the determination of value and the written exit plan would call out for that. Now, Andy's going to talk a bit, but let me mention this right away, that commonly, and especially commonly, when the target transferee is an insider, such as a co-owner or another employee, that we ask the appraiser to determine what is the least defensible value. I want to underscore the word least here, because it turns out that for tax planning, and we'll try to elucidate this further here today, that it is very common to need to know the least defensible value of the company for purposes of transfer, as well as the full enterprise value of the company. Chris, would you jump to the next slide, if you would? Because that becomes a significant part of the planning process. So, written exit plan calls out for the setting of goals in writing attached to the exit plan when they're isolated. An appraisal of the business, probably determining least defensible value as well as full fair market value for 100% interest. And then the exit plan devotes itself toward determining how to reward and preserve, let me strike that, let me say it clear, how to create value in the company and or to preserve the value in that company. And that's a mouthful. Creating and preserving value it typically involves, and the exit plan would call out for, tools such as the following. Number one, every year having a meeting with the key advisors, attorneys, CPA, financial advisor, other key people, to be sure that the business is on track from a tax point of view, from an exit planning point of view, from a legal point of view. That's my bailiwick, to find the legal difficulties and fix them and cure them before the transfer. In my experience, every business has some legal skeletons that need fixed, whether they're corporate record book issues, whether they're employee issues, whether they're qualifying issues, whether they're liability risks. And if we go through the period of the implementation of the exit planning, cleaning up those legal difficulties, then we have a clean company to sell to the transferee, rather than letting the transferee's due diligence find all the problems and then those problems drive down the price. Another key aspect, and we're doing this rapidly, is to figure out a solution to a huge problem, typically. And the huge problem is this. If I am the business owner, typically I am a key part of the day-to-day activity of the business. When I exit 5 years from now, the value of that business may rapidly diminish or diminish the next day, because my talent, my expertise has also exited the business. So a great deal of what we need to do in terms of preserving value of the business is to put strategic goals in place to make the loss of the business owner not a dramatic loss. And that typically involves again, a written strategic method to enhance the value of, to identify perhaps first, and then enhance the value of key employees. One or more key employees that are likely, almost certainly, to stay with the company across the bridge of transfer into the later years of the company when the transferee owns the company himself or herself. Very key point.
David?
Chris?
Should I go back to the previous slide, because I think that's kind of...
Yeah, that's probably helpful, Chris. We're really talking about points 3 and 4 in the introductory slide there, because until we determine how to hold value or create value where the owner is gone, we haven't done our job in terms of creating and implementing this written exit plan. And there's a great deal of depth there. Andy is going to talk a bit about how to do that with key employees and what will hold them to the company at the point in time that the transfer takes place. So in a treetop view, that's what our company is about. It is the creation of, and then the follow-through for, a written exit plan that guides, monitors the transfer preparatory time that is commonly, folks, several years in duration, rather than the hope and the prayer that someday when I get too old to run my business anymore, or perhaps too tired, that somebody will appear and offer me cash for it. So that's what we hope to do in terms of valuation, or in terms of creating the written plan. Chris, let's jump to the third slide and talk about valuation for just a minute. So that's, I think, the next one. What is certainly non-intuitive is what I mentioned earlier, and that is that it's important often that we know what the minimum defensible value is from a qualified appraiser, as well as the full market enterprise value of 100% interest. You know, there are seminars that go on for weeks on how that's determined and why it's necessary. So let me just see if I can give you a paragraph of why that's important. If I sell my business to a third party for cash, and that third party is an insider, which is what our presentation today is directed toward, typically we assume the insider has no money. Let me say that again. Typically we assume that our insider transferee, my son, my key employee, it has no money to buy the business. And if that's the case, where's he going to get the money? Well, obviously, he's going to get the money from the business cash flow itself over the course of time. Well, if I go with my gut instincts and just sell the business to my insider for a note, a promissory note, he'll pay me $1 million over 5 years at a given interest rate, that is highly tax inefficient. Typically, that's highly tax inefficient. Why is that? Well, because to get the $1 million, our owner needs to take $1 million out of the company. To do that, he has to pay income tax on the $1 million, netting him much less because of the income tax haircut. Then when he turns around and gives me the $1 million over the course of time, let's say he had to pull out $1.6 million to get the $1 million to me net of taxes, then I receive the $1 million and I have to pay capital gains tax. So because of the double taxation inherent in the transaction, we need to look at whether our tax consultants can guide us through a more effective and perfectly legitimate transfer from an income tax point of view. And therein is the potential need for the minimum defensible value of the company. Next slide, Chris. And the reason for that is, conceptually, here's what we might do. We might take our insider, and let's say we have a 5-year exit plan in place. In the first couple of years, we might sell, say, 30%, follow me with this, 30% of the value of the company to our transferee, our buyer, our key employee, at a value determined by the least defensible value, the least value of the company that is legitimately defensible from our appraiser. That, of course, minimizes the amount of cash that our employee needs to take out of the company, minimizes the tax impact, and sooner rather than later, our employee hypothetically owns 30% of the company. During that same period of time, we look at other ways that the owner can take additional revenues out of the company in a tax-effective way. Perhaps non-qualified deferred compensation plans, tools like that. Then, 2 or 3 years from now, when our employee buyer owns, 30% of the company, purchased again at the minimum defensible value, he is now arguably, likely, bankable. And on the 4th year or the 5th year, he can hopefully, if we've done this correctly and if the numbers are right, purchase the balance of the business, the other 70% from us, with bank financing he could not otherwise have achieved at the highest defensible value. And when you play the numbers right, and it's certainly beyond our capabilities to do in this short kind of presentation, the success of that is more money to our business owner, to me as the business owner, in a shorter period of time than would be otherwise. So it becomes often desirable from an income tax point of view, guided by our CPA, who knows exactly the approach and confirms the legitimacy of the approach, and the appropriateness of the approach under the law, and supported by a qualified business appraiser, we may be able to effectively transfer the business to our insider who has no money, far better than our gut reaction of doing so by a note financed over time. Let me take a pause here. Chris?
David, I have a quick question from one of our participants who also happens to be named David.
Okay.
He says, I am a sole owner of a veterinary clinic with 2 veterinarians and 6 support staff. My son is the other veterinarian in the practice. What is the best way to sell or transfer the business to him from a tax standpoint? It seems to me that you covered some of that, but I just wanted to give you an opportunity if there's anything else you could add to what you just went over.
Chris, David, I don't think we can. Every transaction is quite obviously an individualized question. Your question is real apropos, though, because it is common, in my experience, for professionals to seek answers like you just asked. Law firms creating successors in interest, dentists in particular I've seen, medical doctors and veterinarians and accounting practices all face that. And many of them intend transfers to a child, a family member who is active. I can't give you more specific. I can only encourage you to seek out the expertise necessary, David, to sit down and create a written plan of what would best fit your circumstance with the aid of an attorney, certainly a CPA, perhaps your own attorney if he's familiar in these areas, perhaps your own CPA if he's familiar in this area, as well as a financial planner to look at where you need to be, as well as where your son needs to be at the end of that transaction. But beyond that, I think it's too specific a question. I can only encourage you to be sure the approach is in writing. What fails are approaches that change with the wind on a monthly basis. The consistency, in my judgment, is the key. The concept of a written exit plan is unique, and it was originated by a terrific group, Exit Planning out of Denver, Colorado. You'll find them on the web. It's a tremendous tool for organizational purposes. Any other questions before I hand the microphone over to my friend Andy?
Would this be a good opportunity to open up the phone lines?
Sure.
Okay. I'm going to unmute all the phone lines, so when I do so, everyone will hear everyone else, and I will say that this is an opportunity.
The conference has been unmuted.
All the phone lines are open. Does anyone have any verbal questions they'd like to ask? Sounds good. I think what I'll do is go ahead and...
The conference has been muted.
Raise your hand at any given time, clicking the button, or send me a text message, and hopefully we'll get an answer for you. And at that point, I think, David, will just turn it back over to you guys.
Fine. I hope that the lack of questions doesn't indicate we've bored them, Chris. I think not, but I hope not. And I'd rather think everybody's just shy.
Yes.
But this is a real important topic, and at this point, I would like to have Andy speak to his portion of this presentation, and again, we'll see if we have time for questions at the end. Again, this is Andy Mamona. Andy is the financial planner of the company, one of the two, David Heffelman being the other. Andy.
Thank you, David. We've talked about a couple of important aspects of the exit plan so far, the setting of objectives, and secondly, the valuation of the business itself. Staying with our theme of an internal transfer, let's talk next about identifying the actual buying group that we're looking for. David touched on briefly establishing the desired timeline, and I would certainly agree that you're looking at a minimum of 2 to 3 years, perhaps sometimes as many as 10 years out. And the longer the time frame that you have, the better, because it allows for increased flexibility and for adjusting to any changes that might occur throughout the process itself. So one of the first things that you're probably going to take a look at in identifying a potential buyer or buyers is your current workforce. Do you have any members of the existing workforce who have the necessary skill sets and the potential financial backing to affect the transfer of the business. Now, I talked about skill sets, and I think this is an important point that I want to emphasize a little bit here. Prior to working in the financial services industry for the last 10 years, I spent about 25 years in corporate America working in a variety of management positions. And it's been my experience and observation that many times people that we assume have managerial skills are sorely lacking in those. I saw in many cases instances where we took a top-performing salesperson and made that person a manager, and they utterly failed because they lacked the necessary skills to manage and work with other people. The same thing if you've got someone who's your top operations person. That person may be a whiz operationally and may do an excellent job in the background in setting things up for the running of your business. But can they effectively interact with customers? Do they have the skills necessary to do the things to operate this business in your absence? And I think David said something very important early on. The more critical that you are to the business, the less value your business has as a going concern, because you ultimately will leave the business itself. So how are you going to create that value on an ongoing basis? Now let's assume, for the sake of discussion, that we don't have internally the right person or persons to take over in the ultimate transfer of the business. In this case, of course, this is why we need several years then to complete the entire exit plan itself, because you're going to have to go out now and seek and hire a potential buyer or buyers if none is present. Could be anyone from a key employee, perhaps, of an existing competitor. Could be a current vendor or supplier that you're working with. There are any number of different options that might, exist out there. And again, you're seeking a combination of the necessary skills to run and operate this business, and probably most importantly, are you dealing with someone that is coachable? Are they trainable? Can you work with this person or persons over the next couple of years to help them develop the necessary skill sets to be successful in operating this business? And last but certainly not least is if they have the financial backing that would help accelerate the actual transfer of the business. Now, again, their net worth, their credit worthiness, as it were, can be an important part in determining whether or not this is someone that you would want to consider as an ultimate potential buyer for the business. So how do you provide the operational and sales training to the identified person? Well, once you've identified them and you've agreed upon a mutually set upon path to developing those skill sets, what you would do is try and look at the areas that perhaps they're weak in. For example, if you do in fact have a top salesman, and that salesman has indicated a willingness or a desire to eventually succeed you in owning the business, identify what his or her weaknesses are, and those should be the things that you really focus your time and effort on improving over time. Now, we've talked just a bit about skill sets. Let's move from that and look a little bit at the financial realm of things. How do we, as David indicated, many times we're going to be dealing with people that do not have the financial backing, that simply can't go to the bank or can't dig into their own bank account to fund the eventual transfer of the business. So the next thing that we want to do is talk about creating an incentive plan that will have two purposes. The assumption here that we have is that the employee doesn't have the cash or credit that is substantial enough to fund that eventual buyout. So the first thing that we're going to do is we're going to create an incentive plan for that individual. And the incentive plan has to have certain components. Number one, it's got to be specific. And as David said before, to the exit plan, the incentive plan must be in writing, not something that is arbitrary, but something that is specific to the actual goals that we're trying to achieve. It should be tied to performance standards, and if it's going to be successful, it must drive the behavior that you want to reward. And finally, that incentive plan has got to be substantial. Typically, we're looking at something that is somewhere between 10 and 25 or perhaps as much as 30% of what the employee's annual income is. It has to be a substantial enough incentive that it is going to provide that individual, with the motivation to achieve what we're trying to accomplish here. And then secondly, the incentive plan should be both, as David indicated before, part cash, because cash is always king. The individual likes to have, something that they can get their hands on at the end of the quarter or end of the year, depending upon how we pay it out. But you should also have it partly tied up with what we call golden handcuffs. Why would it say golden handcuffs? Why are we looking at something that's going to be paid out in the form of a deferred compensation? Well, what we're trying to do, in addition to motivating and incentivizing this individual, is we want to tie them to the company. We don't want them to take a $25,000 or $30,000 cash bonus that we're paying to them and walk away and go to our competitor or go somewhere else the next year. If we're looking at this as a long-range plan, what we're trying to accomplish here is somebody who's going to be here for the long run. So we might take 50% of this bonus. Let's say it's a $20,000 bonus. We pay out $10,000 in cash. The remaining $10,000 would be paid out over a 5-year vesting period. And we'd have a rolling vesting plan in place. So every year, 20% of that portion would vest and would belong to the key person or key employee that we have identified. By doing this, we're creating the incentive and hopefully the partial funding for the eventual buyout of the business itself, but we're also tying more closely this person to the business itself. Chris, I'm going to pause here for a second to see if there are any questions concerning this area we've talked about.
Okay, just to let people know, do we have any questions? Feel free to hit the raise your hand button now. Also send me a text. I think we're going to wait to open up the phone lines again until after, Andy, if that's okay.
That's fine.
Okay, and I think we'll just keep on going, and please raise your hand, hit the raise your hand button, or send me a chat if you have any questions about, or if you'd like any clarifications about what we're going over here today.
Good. Well, with that, I'm going to pass the phone back here to David to wrap up the last couple of points concerning this.
A couple general observations. First, I want to be sure that credit goes where credit's due. The concept of the written exit plan, at least in my experience, was developed by an attorney, John Brown, out in Denver, who's the owner of Business Enterprise Institute, which is a terrific source of information on the creation of a written exit plan. Secondly, I was thinking about David's question, who's a veterinarian. David, there are real specific questions that I suggest need to be answered on an individual basis, but I thought it might be helpful to you to talk about what 2 or 3 of them are. But one is there any gifting component involved in any portion or all or none of this transfer of the practice to your son? What is the estate planning consequence to any gifting of the business to your son? Are we concerned or not concerned about treating other children equally or in some way that will keep the family tight? Thirdly, what is your son's ability to purchase? Fourthly, do you intend to stay involved after the transfer? I mean, one of the goals of a transfer can be that the current owner stays involved at some level, maybe stays involved as a potential partial owner. So those are the kinds of questions, those and others, David, that make your question a very specific question that we can't generalize too far of, The most general and the most important point, I think, is that the questions need asked in a systematic way. They need to be answered in a systematic way, and the answers need to be a part of that written exit plan. If we leave you folks with anything today that sticks, I would hope it's this: that the development of a successful exit takes strategic thinking, and it takes an organization. That organization and that strategic thinking typically involves 3 or 4 different professionals at different times that are on board and that commit to the written document that keeps the course set for that eventually successful move from the business into presumably other lifestyles. Chris, I think that concludes our general presentation. I hope we were able to convey the material effectively in this short of time. Are you there, Chris?
Yeah, I'm sorry, I muted my phone.
Sure.
I had forgotten to advance to the last slide. Was there anything else on there?
No, I think we've covered it. As you know from dealing with us, I'm never strong with slides. I think they're helpful sometimes.
Okay. I did have a question. You kind of briefly touched upon it, but if you could give like a quick minute or two on kind of reiterate the point of the effect of not having that management succession plan in place can affect the value of the business, regardless of whether it's an inside or outside transaction. Probably more so with an inside transaction, but can you just talk briefly
Sure.
how that, what
Sure.
effect that has?
Well, I think it's essentially obvious. I've been a part of business sales where the business owner fully expects that 2 months after the sale, or even the day after the sale, he's gone. Well, when the buyer does what is loosely called his due diligence before the conclusion of the sale, he's going to think through carefully what holes there are in the organization when the owner leaves, and then the larger the holes, the less the value of the company. And the only way to deal with that effectively is to deal with it effectively over the course of years before, whether it's 1 year, 2 years, or 4 years, to think that through and fill in those holes, or at least shrink them, so that the value stays up, and of course then the price stays up. Is that essentially what you're asking me, Chris?
Yeah, absolutely. I mean, it's one of the things that we see often is that business owners plan for the transfer of ownership, but they don't plan as much for the transfer of management.
You bet.
It's just huge.
Well, then I see a question here on the screen. Let me just read it out loud. Should the deferred compensation funds be set aside in some type of financial vehicle, and where should it show up on the balance sheet? That's a question you're going to need to address with your accountant, but basically it typically does not. A non-qualified deferred compensation fund it certainly can be set aside, but it is essentially in its purest form, David, just a promise to pay. It's a legal commitment of the company, don't misunderstand, but it's simply a promise to pay. Now, there are all sorts of financial tools to fund that obligation, again, beyond the scope of this, but a topic that's very important. How do you effectively fund a non-qualified deferred compensation program? So the listeners, our participants, know non-qualified simply means that it is not under ERISA. It is not applicable to all employees, but rather can be selectively applied only to certain employees. Any other questions that anybody has, Chris, that I've missed?
Well, I think what I'm going to do is open up the phone lines again. So I'm going to click the unmute button, which means, of course, that what's going on in your office can be heard by all. So just let everyone be aware of that.
The conference has been unmuted.
In the process of being unmuted, but one of the things I wanted to add to that question is we see the questions lead us in perhaps further sessions in our further programs in our webinar series. It could be topics of separate presentations themselves, because there's like you said, there's all sorts of ways that you can set it up and ways you can go doing it. So again, the phone lines are open. Do we have any questions that anyone would like to ask? I think that's fine. I'm sorry? Did we have one? Oh, okay. I thought I heard something. What I did want to encourage folks, you see the last slide up there, we have David and Andy's contact information. If you want to give them a call, I'm sure they'd be willing to talk to you guys, answer any specific questions that you might have. And I do want to thank both Dave and Andy for doing the presentation. I thought it was an excellent presentation. Again, in the time frame that we have for the webinars, a lot of stuff to cover, but I thought it was well done.
Chris, I want to say that I really appreciate Kent State University, for those that aren't local in Northeast Ohio, to give us this opportunity. It was, as I said earlier, it's my first experience in a webinar, and I thought it was a particularly unique way to communicate, and I look forward to doing more of them, maybe on more narrower topics. So thanks, Chris.
Sounds great. Thank you. Thanks for the kind words. I want to let everyone know that this webinar will be archived, is being recorded and archived, and will be available up on our website probably later today. We have one additional webinar remaining on Thursday morning at 10 o'clock, and it's on family issues and succession planning, another important topic. So I encourage everyone to come out for that one. And thanks, Dave and Andy. And at this point, I'm going to turn off the recorder and shut down the webinar. If you have any questions, feel free to contact us, or Dave and Andy as well.
Thanks again, Chris.
All right, thank you.
Thank you. Please stand by.